Stay tuned for Retire Your Way with Dale Soutas, a leading financial retirement strategist and the founder of Soutas Financial and Insurance Solutions, right here in Fresno. Every week, Dale discusses pressing financial topics of the week, ranging from reliable income strategies to our financial markets, including Social Security, tax strategies, wealth management, RMDs, legacy planning, long-term care solutions, and most importantly, how to make sure you have enough guaranteed lifetime income to retire your way with choice and dignity. From taxes to trends to total transparency, Dale covers it all. And now, here is Retire Your Way and Dale Soutas. This is Retire Your Way with Dale Soutas, financial advisor of Soutas Financial right here in California. It's been a busy time of year. There's a lot going on in the news, but more importantly, what is happening in the financial news of your own situation? That's the economy that we like to focus on. Mr. Dale Soutas, how are you doing this week, my friend?
We're doing fine. Thank you for asking.
You've been quite busy. Haven't you? A lot going on in the offices.
Yes. Yes, we got ones working on their licenses to help, to build up the ones we can help others with, more advisors. So that's a good problem to have.
Yes. Always nice
Our
to
new office is great. If ones haven't been by, you're welcome to swing by, have a cup of coffee. We're right here on Palm near Bullard.
Okay. And we got a lot of phone calls last week from financial this or that. So we're playing just a little bit of fun. A lot of folks think that the answers to their retirement should be black or white, but there's a lot of gray area, and we really like to kind of dig into each situation. It isn't just about the investments. It's about what kind of lifestyle are you trying to build. In fact, I think in a little bit here, we got a story of somebody who you spoke to just a day or two ago. But I am going to continue on our financial this or that because we had so many of them from questions we had received and the kind of conversations we have in the offices. So I want to ask you this today. Delaying retirement, early retirement, how do we know when is the appropriate time for us to go ahead and retire? Should we wait longer or do it as soon as we can? This or that, which do you prefer?
Yeah, I mean, delay versus retire early. If you can retire early, wouldn't that be even better? It's so nice to show people who really would like to get on with other things, maybe not be so busy with work, tied down, be able to spend more time with family or their hobbies, interests, sports activities, whatever it is. It's really one of the benefits of, or things, how do you put it? When you are very satisfied with what you do work-wise, it's very encouraging to help people see, I can actually retire now. I don't have to wait 2-3 years more. It's encouraging to be able to help people see that, to crunch the numbers, to see your money will last. You can do all the fun things you want to do. And I put out your income plan till age 100 to make sure you know that your money will last and you'll keep up with inflation, be able to have a paycheck to maintain your lifestyle, build inflation into that, have a paycheck to be able to do all the fun things you want to do, and even build a care check in so that if you need help down the road, you could be confident that your income will be there to keep you out of a nursing home. Those are encouraging things when we show people that everything's going to be okay for the long haul.
What are some of the considerations, though? What are early versus, and I don't know about the word late or maybe later, Are we considering the timing of retirement on our age, our health, how much we love our job, how much we dislike our job? Is it dependent on amount? What are some of the things that you evaluate?
Well, that's the fun part. Everybody's different. So sometimes I get people in, like recently I had somebody that, in their early 60s. So they're going to need health insurance if they retire, because right now they do have the benefits through work. But if they retire, they realize they're going to have to buy health insurance on their own. And that can be expensive. It all depends on income. It depends on other things. But let's say your income is, too high to get the subsidized, covered California, as they call it. Then you're looking at maybe $500 or $600 a month per person to have, health insurance. Well, Okay, can we build that into the budget until you qualify for Medicare and go on Medicare A and B and get some kind of supplement or Medicare Advantage plan or whatever you want? Sometimes the health insurance is a factor. How about job satisfaction? Think about it. How many times do I have people who they want out? I've had enough. Management's changed. Different things have changed. It's stressful. I just want, yeah, I want out. That can be something that is motivating, obviously, to look at how do we do that sooner than later. Some people are very satisfied, or they have their own business and they love what they're doing. Okay, how can you keep doing what you enjoy, but maybe not be so tied down, be able to still spend more time with family, friends, more important things? And then what if you've done well? I had somebody recently, she's single, she's got plenty of money saved up, and it would be a no-brainer. She's already put in that she's going to be retiring later
Oh,
this
good.
year,
Good.
and it's wonderful to show her, even though she's still with a lot of questions. That's okay. But you go to the doctor, and because you have a concern, or they're going to ask you a lot of questions. And so
Hmm.
sometimes I need to say, okay, you got a lot of good questions, but before I can answer any of them or most of them, I need to ask you a bunch of questions. I need to kind of
Yeah.
get into your head. What do you want retirement to look like? Number one, what do you want to be able to do or do more of? What do you have currently as income, projected income, Social Security, pensions, rental incomes, whatever? What do you have saved up? What
Hmm.
types of money? Is it tax deferred? Is it tax free? Is it taxable? Things like that. And then we work up your plan based on you and your goals. So,
You had a couple recently. A lot of times the conversation that folks have is downsizing in retirement. Let's go down from our larger property.
mhm.
You had a couple though recently who also came in, and it sounded like they wanted to upsize their lifestyle. They wanted to get themselves out
Yep.
to the coast and
Yeah.
and hey, enjoy this retirement lifestyle. Does that give you a little pause on the retiring early or late? Like, yeah, hey, that's okay, but if you're going to make your lifestyle more expensive, we've got to make sure you got the funds for it there.
Right. I can think of this one couple I did help. It was actually a few years ago, and they definitely wanted to be out towards the coast. They were looking near Pismo, I think Napomo. They want to be near the coast, the cooler weather, if they could, even a house right on the coast. And what was interesting is their savings was pretty decent. And I've known the family for a long time, worked with the mom years earlier for dad's long-term care needs. And unfortunately, mom had passed away, but the only child, the son, did inherit money. And that put him in a better position to upsize. Is that the right word? I don't know.
Yeah,
Instead
upsize,
of
I guess.
downsize, they're gonna upsize. That
Yeah.
makes more kind of sense. Um, so they were looking different places, and a friend of theirs said, "Well, why don't you look in Oregon?" And they
Hmm.
did, and they were, looking on California coast back then, and it was, well over $1 million, even if you're inland a little bit. Yet when they looked at Oregon, they found a house that was actually bigger than they really wanted, but it was right on the coast. They have an ocean view, not too far from the ocean, and it was for less than 450,000. They were able to pay cash, still have money you know, to burn, so to speak, or to use in retirement, and they're doing very well. I had somebody recently who likewise says, "I don't want to downsize. I too want to, you know, upsize. I want to find a better location, better weather, possibly even better. It might be out of state, lower
Hmm.
taxes and stuff like that." And so we're working together actively now on, well, as your plans change, as you find places, we need to put our heads together. Number one, how do you finance that? You're going to sell your property. You'll have money to at least put a down payment on it. How do we structure things to make that move, to upgrade,
Hmm.
uh, upsize, or whatever we want to call it?
Yeah,
So,
even
and she's
upsizing
done
our
well
lifestyle.
saving. She's done very well saving. Um, so she does have means to definitely upsize and be in a better place if she'd like to do that. So as her plans and as we work through this, because she's not retired yet. So that would be something we can, we just take people by the hand through the whole
Yeah.
process. As things change, life throws different things at us. We take you by the hand and walk you through it.
It's a delicate balance, and we want you to consider both of the options, whether it's early or late, but you know what? It's your life, it's your retirement, and some of it has to do with the math, some of it has to do with what you've saved, some of it has to do with your own health, but we want you to be able to enjoy your retirement lifestyle as long as you can, the way that you want to. It's literally retiring your way. So wouldn't you like to know, can you do it sooner? Do you need to work a little bit more? Let's find out for sure. Let's find out the facts. Call the phone number. Let's get you started on your own absolutely free portfolio review. I don't know, what do we want to call it? Am I ready to jump off the retirement cliff? I don't know. Does that sound too scary?
Well,
Maybe
if you enjoy if you
Yeah.
have things that you would really like to do or do more of, why not find out can you do it sooner rather than waiting till later?
There you go. That's the way to say it. Call the phone number. Let's find out sooner than later if you are ready to go into retirement. 833-856-1382. Ask for your free portfolio and retirement review with Dale Soutas, financial advisor of Soutas Financial. More Retire Your Way right after this.
Do you know how you'll generate income from your investments along with your Social Security in retirement? In our opinion, it's never too early to start the income planning process for your future. An income plan can help you work towards creating a steady stream of income to support you throughout your retirement years. Don't leave your financial future to chance. Take control today and start income planning for your retirement. Call the team at Soutas Financial so we can help you design a complimentary written income plan to help you live the retirement you've always wanted. Call 833-856-1382. That's 833-856-1382.
Welcome back to Retire Your Way with financial advisor Dale Soutas of Soutas Financial. Our listeners out there seem to enjoy some of our financial this or that. Me playing the game show host and asking Dale between either strategies or choices or tools to try to help everybody out there figure out this complex game of retirement planning. Ooh, I like this one. I like it. We got a good financial this or that. Paying off your mortgage versus keeping the cash invested and continuing to pay off the mortgage. Should we take out a big chunk of money and pay it off to be debt-free, or continue to let it grow and just pay the mortgage over time? This or that. Which one do you prefer? Hey, I mean, come on, debt-free is good, right? Shouldn't we pay this thing off?
Depends on how you pay it off. Many times I see people, they have decent savings for retirement. A lot of it could be tax deferred. In other words, like a 401k, TSP, 403b, something like that. And they're at a point where, hey, I could take, 100,000 out and, eliminate the balance of my mortgage. Well, yeah, but then you're kicking your income up by 100,000 all at once. So you probably have to take 130,000 out to net, 100,000 after tax. You're reducing now that nest egg that can be used long term for, your lifestyle. In other words, income. Income is what you need to maintain the lifestyle that you want. It's not a lump of money. Oh, I got $1 million in the bank. Okay, great. What do you need to pay the bills? And if your Social Security, pensions, whatever's are not enough, how are you going to draw from that $1 million? The drawing from it, if it's up and down on the stock market, could reduce quickly. But in other words, to pay off the mortgage or not necessarily. Everybody's different, but a lot of times people think they have to wait until the mortgage is paid off even to retire. And
Yeah.
that's not the case. I have many people happily retired. We build into their plan not just what we preach, the paycheck, play check, care check, but I might separate the mortgage out separately, what they pay for the principal interest, and map that out over whatever time they're going to pay just the main minimum, or maybe they say, yeah, I'm going to put a little bit extra. So we factor that in as a separate category because the mortgage will eventually go to zero. But think of it this way. What if your mortgage interest rate's 2 to 5% and your money is growing at 6, 7, 8% or better. Why would you pull from money that's earning more than what it's costing you to have the mortgage? It wouldn't make sense. So there's a number of reasons, a number of ways to look at it. But what if you can retire even if you have a mortgage, but we build that into your plan so you see, hey, our mortgage, we will eventually have it paid off, hopefully within a few years after retiring or so. And we don't have to reduce our nest egg, our savings, to be able to retire sooner than later. That's still kind of the same.
What do you think? What is the driver, though? Is that just that feeling of being debt free? They're saying, "Hey, because I appreciate what you're saying." There's a lot of folks who say, "I can't retire until I pay off the house." Oh my gosh, I got to keep paying this. Is it just that feeling of being debt free? Is it not understanding that maybe you might be able to make more than your interest rate by keeping the money invested?
Well, what if they what if, let's say, they have Social Security.
Okay.
That's their main income source, let's say.
Okay.
Or maybe they have on top of it small pensions, nothing gigantic. Okay. And that's not really enough to pay their bills, the paycheck, what we call, the month in, month out bills with inflation over time. It's not enough to spoil the wife, the playcheck, so to speak, to, do the fun things you all want to do. So we need some of the savings to position in such a way that we can get more guaranteed lifetime income, preferably, so that now your income goals are solid. But if you use a big chunk of your nest egg to pay off the mortgage, and now you don't really have enough to use in other ways, it makes it harder to, you might have to delay starting retirement to build your savings back up. It could be a number of different things, but basically if you have savings, why reduce it if you don't have to, just to pay off the mortgage? The mortgage can be built into your income plan. And what if you're in a better position to have better income? Now you could pay down that mortgage even faster because everything you pay above the minimum payment is going to reduce the balance and interest. They're simple interest loans. So by paying extra, you're reducing that even quicker. I mean, sometimes people don't realize you get a 30-year loan. If you just doubled up the payments from day one, you'd probably pay it off in less than 8 or 10 years. You can pay off very quickly because of the type, it's simple interest loan. And you have more control on paying off your mortgage than many times you realize. So I don't usually recommend people just like a knee-jerk reaction.
Yeah.
Yes, you got to pay your mortgage off to retire. No, many people are able to retire and they still have a balance on their mortgage. We deal with it.
I love that. I love that answer. So, should you pay off the mortgage? Should you keep the money invested and keep paying it off even into your retirement years? You might not be seeing the tree inside the forest. And I know, obviously, it feels great to be absolutely debt-free. But if your interest rate is lower than what you might be able to make consistently in the market over time, you're actually losing out. You're actually hurting your financial plan more. So call the phone number. Let us help you figure out. If you're that close, I get it. You want to pay the house off before you retire. But let's find out exactly where we want to move the pieces around the board before you do that. 833-856-1382 is the phone number to reach out to. There's no cost to talk with Dale. There's no cost to schedule a time here with the team. We can do it over the phone, or a lot of people like to do it in person, so you can come in and meet Dale. 833-856-1382. In a similar vein, thinking about, kind of monthly payments or, paying off a big chunk. For those who might be fortunate enough to still have pension plans, what about lump sum payments versus the monthly payments? Or if your retirement plan is winning the lottery, what should people select? Should they take the lump sum or the monthly annuity payment for the rest of their life? If you've got an option to help somebody before they turn on a pension, do you have a preference on one of these?
Good question. It all depends. Again, everybody's different. So how do we, whether it's paying off your mortgage or not, whether it's taking the lump or taking it over lifetime or whatever, we stress test it. We put it into your plan. We play with the numbers and with your goals in mind to see how does that affect your longevity with your money. Will it last? So I just had somebody recently, that's funny you asked this one, and he has a very good high pension already. But the employer, he had a supplemental pension and also a buyout. They're wanting him to retire early. So both of those he can turn into income over time or lifetime or joint with his wife. Yet his pension and their Social Security amounts are well above what they need just to pay the bills and do all the fun things they want to do and so on. The play, pay, and care checks are solid with what he has coming in once he retires with that big pension and all. So I was showing here, instead of taking the income and now paying tax on that forever, why not roll it over, which he has the right to do both of those, into an individual retirement account, an IRA. And now he could be in a position over the next, say, 5 years, while we still have the low tax rates, to convert that to Roth and make that money, grow tax-free for his spouse to use if he dies first, and or to pass on to the kids tax-free. So everybody's different, but in their particular case, it did not make sense to convert it to lifetime income. It made more sense to take it, roll it over, and be in control of that money, have more money available for any extras they want to do in retirement. So they have more flexibility throughout retirement too that way.
Yeah, and it might seem like a real simple answer here. And say, hey, I don't want to manage a whole big lump sum like that. I don't, I'll just let the company turn it into, monthly payments. And you might say to yourself, well, I'm not going to have a pension plan. But this is also kind of the question for yourself out there is, how do you create a pension-like plan for your own saving, meaning your own 401ks?
Right.
I mean, since it's not out there, same thing. It's like, what do we do with that lump sum to turn it into those monthly payments, Dale?
Yeah, there's different companies have give you the ability to either take your pension as a lump, roll it over, and if you do it properly, you don't pay tax on that big lump of money, or obviously you take it as income. I think of several I've helped that way, and I've shown them, if you take the money and roll it over here, and now we have it managed properly, because let's say in the first case that the income is fine, so then they don't need that to produce more income. But basically, it's really simple. They have more control over that money. It can do more. Sometimes they do need it, but there are other tools that can provide a better income than what the employer is offering, and lifetime to boot.
To find out what would be best for you, whether you might be receiving a pension plan or how to turn your own lump sum of life savings into your own personal pension-like plan, or wondering, should you pay off the house or continue to let your investments grow and just pay off your mortgage as you're regularly scheduled to do so monthly? If you're wondering about these questions, call the phone number. Let's find out the right answer for you, for your situation. 833-856-1382 is the phone number. Reach out to it, call us, we'll schedule your time, no cost to you. Or if you want to, you can schedule a time at the website, Soutas.com, Soutas.com. More with Dale Soutas right after this.
Are you worried that you waited too late to start your retirement planning? That you waited too late to start saving? At Soutas Financial, we believe it's never too late to start planning for your future. We can help you develop a personalized retirement plan that is tailored to your current needs and goals. The team at Soutas Financial will sit down with you and provide an evaluation of your current path, including your investment strategy, tax planning, and risk management approach. We'll help you identify potential areas for improvement and work with you to create a retirement plan that is designed to help you work towards having financial security and peace of mind in retirement. It's not too late for you to get started with Soutas Financial. Call us today to schedule your complimentary retirement planning session. We believe we can help you get on the path to financial security and peace of mind in retirement. Call Dale Soutas and the team at Soutas Financial to get started on your own complimentary written financial plan. Call 833-856-1382. That's 833-856-1382.
You've heard the phrase, you don't know what you don't know, and we believe it's especially true when it comes to retirement planning. There's a lot of information out there, and it can be overwhelming and confusing. So how do you know what you don't know? Social Security, RMDs, estate planning, investment risk. These are just a few of the many areas that a financial advisor can help you navigate. But what else don't you know when it comes to retirement planning? Are you aware of all of the tax implications of your investments? Do you know how to optimize your Social Security benefits? What about your long-term care and estate planning needs? We believe that by working with a retirement planning advisor, you can uncover potential blind spots in your financial plan and gain a better understanding of your options. Don't let unknown factors potentially derail your retirement. Call Dale Soutas of Soutas Financial to uncover what you may not know about your retirement future and start your complimentary written financial plan. 833-856-1382. That's 833-856-1382. Or you can write Dale at dale@soutas.com. That's SOUTAS.com. Welcome back to Retire Your Way with Dale Soutas of Soutas Financial, extending the run on our game show, Financial This or That. We're trying to get in as many topics. And more
door
so
number one, door number two.
Yeah, as many answers as we possibly can for folks, because there are so many questions that come up with retirement planning. This is a big one. This is a huge one. This one can really have an effect on your life savings for the rest of your life. Financial This or That. Long-term care insurance versus self-funding or self-paying. Long-term insurance, or pay for it out of pocket yourself because maybe you don't need it. I don't know. What do you think on this? This or that?
Good question. Yeah, it's, most people don't even want to consider it, but long-term care is the big thing that causes people to do a whole lot of nothing once they retire, because they keep saying, well, they got this lump of money. They said they want to travel. They want to buy the boat. They want to do this, that, and the other. And then they retire and they do nothing and their money just grows. I said, well, what happened to all those plans? Well, no, just in case. Well, I don't want my families that I work with living a just-in-case retirement. And I ask them, well, what do you mean, just in case of what? Well, in case something happens. Like what? Well, like a medical. Well, don't you have medical insurance? Well, yeah, I've got Medicare and a supplement or whatever. And you're not going to go broke because you have that. They're talking about, what if I need care? Because Medicare, your supplements don't necessarily pay for long-term care. Like if you need care at home, that can be expensive. If you need to be in assisted living or nursing home, even more expensive. Although if you try to pay for care at home 24/7, you're paying double of what it costs to be in a nursing home. Nursing homes in California run over $14,000 a month if you're paying out of pocket. So not to scare people, but yeah, I see why people, just in case, but a proper plan is needed. So is it wise to buy the long-term care insurance? I'm not a big fan of that stuff. I mean, if you already have it, great. We'll review it and make sure you know how it works, and we'll back you up if you need to use it. But think about it this way. If you buy long-term care insurance, you pay forever typically, month in, month out, year in, year out. If you just decide to fall asleep one night and not wake up the next day and not use that, that's a lot of money that went out the window. So I'm more in favor of building in a care check into your retirement plan. In other words, have a system where if you do way down the road need help, how to stay out of a nursing home, how to pay for care at home, how to be in some kind of assisted living, cruise ship on land. Some of those are nice, right? And we build that into your income plan. Have a system where you could either turn on some additional income if and when you need it at your choosing, or have your income growing in such a way that when you get to those later years, you have much more income than you could ever spend, and it'll easily keep you out of a nursing home. So there's a lot of good ways to do that. I'm more in favor of showing people how to stay out of a nursing home and pay for care in, an assisted living cruise ship, or even while it's practical and safe to stay at home, how to stay at home. And there's a lot of ways to do that other than the insurance. And there's,
Mm-hmm.
we're known for the government programs that pay through Medi-Cal and VA, and the Medi-Cal for long-term care is different than the welfare Medi-Cal rules. The asset limits and income limits are different, and so we've been known for helping thousands of families that way. But for my brother-sister types, I want to build in a care check so if you need that, it's covered. And now your focus is on all the fun things. You're not holding back on doing the fun while you're retired because it's covered.
When you were talking about some tools that sometimes have let's say, a long-term care rider, I'm imagining that's, again, in the insurance world. We've talked about it a little bit before. There's both life insurance and annuities, I've heard, that can have this long-term care rider that are different than what you said when you said before you're not a big fan of long-term care insurance. You mean just like as itself, like a standalone policy?
Well,
Because
even having to have a rider on a policy isn't always necessary. Although,
oh, okay.
a couple I had their review just recently, years ago, we set up accounts and we had them pull $20,000 a year from a tax deferred, like a 401k, that we rolled over to an IRA, and they're using that to fund a life insurance policy on the wife, because if he needs care, he's older, and he'll have some help with her, but for her, likely he's not going to be around to help her. So the life insurance actually has what we call living benefits, which mean the death benefit, in her case over $600,000, is they funded it with $20,000 for 10 years. They put $200,000 in, but the death benefit on the life policy is over almost $650,000 actually. And she can use that for things like a terminal, critical, or even chronic illness. A chronic meaning that she would need help, assisted living, even a nursing home. But no, use it to stay out of a nursing home. And she could use up to 24% of that death benefit per year, tax-free, for care. So there are some hybrid tools that can be used, but a lot of times I'm just showing a simple plan. Have your care check built into your income plan, so your income either grows or we have something we can turn on down the road to keep you out of a nursing home. So again, everybody's different. What's the best method? Rarely do I even use those living benefit programs now, but they do have their place. And especially if you're young, the life insurance can be a tool for tax-free income, as well as those living benefits for them too. So
I'll take the opposite side for you. So the self-funding. Now, having insurance, the last thing you want to do is buy a brand new car, and 2 years later have it be totaled, and you got to go out and buy another brand new car. And cars are very expensive today, so we get insurance. We have to have a car insurance. If we are insuring our nest egg, which could be $1 million, $2 million, or as you like to say, oodles and oodles of money. Why, even if we have the money, would we pay for long-term care insurance out of our own pocket or long-term care, like going into a facility, a location? When I say facility, you like to say these cruise ships on land, they're very, very nice places.
Why would we want to use our own money?
Why would we use our own money if we don't have to?
It's easy. It's easy. Okay, some of the income tools we use increase over time. So the income doesn't stay level for the rest of your life. It can act more like Social Security and pensions that have cost of living increases. But some of the tools we use actually increase as you earn interest. So these increasing income tools, let's say you put $150,000, $200,000 into an annuity that can provide guaranteed lifetime income that also can increase after you turn that income on. Once there's nothing left in the account, the income is still guaranteed to keep going and growing as long as you're alive. Now, whose dollars are you using to pay for that care? You're basically in the insurance company's pocket. You're not pulling from savings here or investments there. You have an income stream that likely will be more than what you need to stay out of a nursing home. Or what if you have a tool down the road you could just turn on and that can provide some additional income? You're leveraging your money is maybe a way to look at it. But basically, no, I'm not a big fan of just paying, directly from checking savings and just paying for it that way. But leveraging money, with the annuities, eventually you're in the insurance company's pocket, because once there's nothing left in the account, the annuity income continues, basically like your Social Security, like your pensions. What is it? What they say about Social Security, after about 4.5, 5 years or so, maybe 6 years, you've gotten out of Social Security more than you ever put into it. Because what is Social Security? It's a guaranteed lifetime annuity. If you have a pension, PERS, STRS, or from PG&E or whoever, that's a guaranteed lifetime annuity. So we use annuities at times to provide the extra income you need, so your plan is solid. You don't have to worry about your income throughout retirement. You could focus on other things, and the other money you have more flexibility to do what you want with that money. Maybe you want to help the kids out and see how they can benefit now ahead of time, or maybe you just want to do more in retirement. But leveraging sometimes your money in such a way to cover long-term care can be also with an annuity where your income grows, like I said, well above what you need just to, stay at home alone or something like that if you need care.
To find out the right kinds of tools or strategy that can work for you to make sure that your health is covered all the way through your retirement years, that we don't draw down your nest egg. Read that statistic before as well. Sometimes for some Americans, the most amount of spending they ever do in their life is the last year or two of their life, as they spend it on their health needs. Let's make sure we've got a plan in place to protect your nest egg for you and for your family. Call 833-856-1382 and ask for your portfolio and your health plan review. Dale is not a doctor, but we do know what these costs are and what it looks like to have to pay for all of these things later in life. And we also know all the ways around the California state system and ways that we can help and make sure that you are protected. Call the phone number. Let us help you with your portfolio and your health plan. 833-856-1382. There's no cost to sit down with Dale. There's no obligation. More Retire Your Way right after this.
Stock market losses have you worried? Claim your free portfolio risk report and protection review from financial advisor Dale Soutas of Soutas Financial right now. Call 833-856-1382. If the recent market volatility has you worried about your retirement investments, you're not alone. Right now is the time to take action to protect your investments. Surely markets do not always rise, but if you're in your 50s, 60s, or 70s, you don't have the same time to make up for portfolio losses as you did in your 30s and 40s. Claim your portfolio risk review from Soutas Financial today. Call 833-856-1382 or go to Soutas.com. Your portfolio risk review will provide action steps of what you could do to protect your wealth from current market swings. Get your free portfolio risk review right now. Call Dale Soutas of Soutas Financial at 833-856-1382. That's 833-856-1382 or Soutas.com. That's SOUTAS.com.
This is Retire Your Way with Dale Soutas of Soutas Financial. Still playing some financial this or that this week. We're trying to get in as many topics as possible for you to get as many answers for you. I really like this one. What about, as we have a nest egg and we feel like our savings and our income spend is going to be totally fine, what about gifting during our life to our family versus leaving it all in an inheritance? Do you have a preference?
Yes. They can gift to me. I keep deposit slips in my desk
Oh,
drawer.
stop it. You do not.
Yeah, I do. I show people. No, I tease them. But anyway, yeah, that's a good question. The Baby Boomer Dilemma movie is excellent. If you haven't seen it, check out the 2-minute trailer on our website at Soutas.com. And in that movie, it shows if you truly have your retirement income plan solid and you know your income is going to last as long as you live. We put it out to the wife's age 100 with inflation, okay? Your goal of whatever you need today needs to increase every year for to cover inflation. If it includes the play check to do all the fun things you want to do and a care check to keep you out of a nursing home, and you still have money galore, however you want to put it, gobs or oodles, and you'd like to gift to your children and see them and or your grandchildren benefit by it, or maybe to charities or whatever, well, that would be better than just knowing that it's going to end up going to them anyway. If you don't really need the money and you'd like to help them out now, like the movie talks about, what if some extra money can help them be in a better place for the kids, maybe better schools, districts, all that, safer environment. Well, wouldn't that be nice to be able to do? Yes. If
There's
you
some
have
pretty big thresholds as well right now, I think. I thought it was 18.
Big, yeah.
How much?
Well, but think about it first. If you're in a position to help your kids out, you'd really like to, but you're worried about, will my money last? Then you need a better income plan. Now, let's say your income plan's solid. Now let's go to how much can you give away? Many people have heard you can't give away more than 10,000. Yeah, it used to be 10,000. Today in 2026, you can give, mom can give the son or daughter or a grandchild 19,000. Dad could give 19,000. So a married couple can give to their children, each individual child or grandchildren or anybody they want to gift to, up to 38,000 without having to tell Uncle Sam they gave money away. When you exceed that 19,000 amount per person, let's say you decide, let's have fun. Mom and dad decide to give their daughter $200,000. Well, they've exceeded the 38,000. What that did to Uncle Sam was just requires mom and dad now to file a gift tax return to say, oops, I gave more than 38,000. Now, what happens there, mom and dad do not have to pay gift tax because they're filing the gift tax return. So it would make sense. Who pays the gift tax? Not the kids, the parents. How can mom and dad not pay the gift tax? They take that $200,000 off of their currently, don't hold me to the number, but it's like 30 million federal estate exemption. So now they can give away $29,800,000 without any estate tax. So there's no gift tax for mom and dad. Now, the daughter who received the $200,000, that was a gift. It wasn't earned income, so it's not taxable to her. So you can give away more than that 10 or now 19,000 per person without incurring any taxes for the giver or the recipient. If people aren't sure about that, are you sure? Then I'll put you in touch with my CPA who will explain the nuts
why do they
and
say
bolts.
that number then? I'm sorry, help me clarify. You're allowed to give 19,000 per person, any gift. And I think that works in any way. You could do, brother to brother. I could gift with no tax implication. But let's say, so mom to son wants to give $21,000. Okay, let's just say unmarried. Let's keep that.
When you exceed that,
when
you exceed that, that's just technically triggering a reporting requirement when you gift more than the 19,000. It's not necessarily a tax liability. Keep in mind, years and years ago, the federal estate exemption, if you die, mom and dad could pass on, let's say, $600,000 without any estate tax. Now it's like $15 million each. So $30 million, mom and dad can pass $30 million on to their kids without any estate taxes. Everything above $30 million, the kids would have to pay 40% in tax. Well, there's not too many people I run into week in, week out that have more than 30 million. Now, let's say they do, then there's fancy things we do to use that 19,000 per person to set up tools to pay for that tax down the road so the kids don't have to. But for the normal people out there that don't have 30 million or 15
Okay,
each
yeah,
to pass on, you can give away as pretty much as much as you want. You don't pay any gift tax. The kids don't pay gift tax or income tax on that gift. Again, if that confuses you or you're thinking, no, I heard differently, just let us know. I'll
Okay,
put you in
yeah.
touch with a CPA who can clarify that.
Yeah, and you can call us here on that. So do we want to be gifting along the way, helping the kids out, enjoying it while they're around? Maybe it could help them with some of the housing costs or the education costs of the kids or the the daycare, whatever it might be. Maybe you can see them lighten up their life a little bit, while they are around and while you get to enjoy it. Or do you want to leave it all? And it's going to lead me to my next question. Dale, I know you want to say something here, but real quick, phone number 833-856-1382 if you'd like to figure out how can you properly gift. Dale, you had to follow up real quick.
Just real quick, I had a young couple ask about, for their 2 boys that are 3 and 6, they want to set up a 529 plan to help them for education in the future. Well, they can put in $19,000 each, so $38,000 each to their children, 529 plan, whatever. But then grandma, grandpa can do the same thing, so they can really max fund the kids' education fund, a 529 plan, very rapidly, using up to that 19,000 limit too.
All different kinds of ways that we can give to the next generation. I know that we could spend a lot more time on this, but I want to get one more in because it's kind of in the same ballpark, and it's all about giving. Having qualified charitable distributions versus just giving straight up to your church,
charity,
your synagogue, your charity, your educational institution. Do people use QCDs enough? Maybe you can explain this pathway.
Or do they understand them? Many times they don't. It's really, now that we have more of a standard deduction when we do our taxes, we're not itemizing. And if you're not really giving a ton away to a charity, even if you're itemizing, you're not, showing a ton of that. But what if you have a charity you regularly give to? Maybe it's your church. I have a little lady, her IRA, she has to take a minimum distribution, required minimum distribution, RMD. And let's say it's around $5,000 a year, but she's regularly giving $200 a month to her church. So I pointed out to her, here's a way to do it. Now, when you give that $200 a month, $2,400 a year to your church, you're not able to really itemize that. I mean, the church still benefits by it, but you're paying tax on that money you gave the church. But what if your RMD, we have $2,400 of it made out to the church from your custodian, and the balance you get and you pay tax on, you spend. So now the $2,400 is made out to the church. You give it to the church. You've met your RMD, but you pay zero tax on that $2,400 that you gave to the church. So there's some really nice ways. What if people who say, hey, yeah, I know I have to take that RMD, but I don't need it. I don't want it. Well, you can't really be stubborn about it, as we talk about our workshops at Fresno State, because there's a penalty. If you don't take it out, you eventually have to pay tax on that amount that you should have taken out plus a 25% penalty. So it doesn't pay to be stubborn. But if you really don't need that money out of your tax-deferred IRA, 401k, whatever, why not direct it to a charity or charities? And then you're meeting the RMD, but you're not paying tax on it. It's not inflating your income. Again, many people don't realize that down the road, that tax-deferred account, they got to take money out. Yet, what does it do to your income? It goes on top of all your other income. So now that chunk of money is taxed at whatever highest bracket you pushed up to. So knowing how to, give some or all of it to a charity can reduce your taxes.
And you might think it feels weird or awkward. So why would I talk to my financial advisor or my tax person about? I just want to give it to my church. I just want to write the check, because you could be doing it better for yourself and for whatever institution you want to give it to. So whether you should do it through what is known as a QCD, qualified charitable distribution, it's just knowing the right pathways to make your own savings and your own retirement more efficient. And the whole reason that we do this program, and Dale is in his offices working hard with the team, is to help you make all of the right decisions to retire your way. Folks, call the phone number. Let us help you with the question marks in your retirement. 833-856-1382 is the phone number. Call it right now. We got folks who are standing by. Unfortunately, that's going to be all the time that we have with Dale for this week, but the phone number will still be live, or you can go to the website and you can schedule your own time right there at Soutas.com, Soutas.com. Click on my free portfolio review or call the phone number, 833-856-1382. For Dale Soutas and his team, I'm Spike. We'll be back again next week.
This is not endorsed or affiliated with the Social Security Administration or any U.S. government agency. This is not endorsed or affiliated with any federal Medicare program, nor any U.S. government agency. If applicable, we do not offer every plan available in your area, and contacting us will direct you to a licensed insurance agent. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all of your options. Any comments regarding safe and secure investments and/or guaranteed income streams refer only to fixed insurance products overseen by state insurance regulators and not any investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. As a valued radio listener of Retire Your Way, Dale and his entire team of retirement professionals invite you to schedule your very own complimentary retirement plan review session. 833-856-1382 is the number for you to call. If you don't have a retirement strategy mapped out that includes low-fee investment elections, tax minimization strategies, decumulation plans that will last as long as you need them to, then call for your very own retirement review session, complimentary for our valued radio listeners. Are you able to lower your taxes in retirement? Are you unclear about your Social Security, Medicare, investment fees and risk, or how to produce guaranteed lifetime income so your lifestyle and goals don't have to be changed with the ups and downs of the market or taxes? Call Dale Soutas with Soutas Financial and be confident you can retire your way. Schedule your own comprehensive and complimentary retirement review session. Don't just live in retirement, thrive. Call 833-856-1382. That's 833-856-1382.
Investment advisory services are offered through Foundations Investment Advisors, LLC, Foundations, an SEC registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any discussions of specific strategies are for informational purposes only and have been provided to help determine whether they may be appropriate for your specific situation. If applicable, the primary goal is converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. Each individual investor's situation is different, and any ideas provided may not be appropriate for your particular circumstances. Comments regarding a particular client's experience may or may not be the same as another client's experience and is not an indication that any client or prospective client will experience the same or a higher level of future success or performance. Foundations only transacts business in those jurisdictions where it's properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Nothing herein constitutes a recommendation that any security, portfolio, or securities or investment strategy is suitable for any specific person. No legal or tax advice is provided. Please review your retirement, tax, and estate legacy planning strategies with a legal tax professional before transacting or implementing any strategies discussed herein. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not in any way refer to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. This is not endorsed or affiliated with the Social Security Administration, any federal Medicare program, nor any U.S. government agency. If applicable, we do not offer every plan available in your area, and contacting us at the phone numbers provided herein will direct you to a licensed insurance agent. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all your options. All rights reserved.